You do not want to miss this episode. We've got a special edition of Control and Compound. We've got the wealth coaches in the studio today, and we're going to share the biggest surprises we uncovered when we were first learning about the infinite banking concept. So we're going to go around the table quickly. We've got Christina Wyatt, we've got Connor Eagleson, we've got Jake Mitchell, and we've got Dan Spry. We're excited for this episode. Christina, what do you think?
I'm excited for the episode, but before we dig in, I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review for us. And if you're listening or watching on YouTube, please like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound on Instagram and TikTok.
All righty. So, so we're just going to kind of go around the table, share some of the stuff that surprised us as we've been doing this for all of us for a while now. Let's start with you, Dan. What shocked you when you learned about this concept?
The biggest revelation for me was, again, having come to Control and Compound from a traditional banking background. I was a commercial banker for over a decade with one of the big banks here, and doing a lot of cash flow financing, acquisition financing, that kind of stuff. Traditional, typical lending. And every year we would ask for financial statements for the clients, and typically at the time when they started to need money was obviously when we couldn't give them any, and when the times were good, that's when the banks all sort of line up at your door and offer you stuff. And the revelation came when you realize how these high cash value life insurance policies work is you're essentially becoming your own banker, and you don't have to go to the bank to get that loan, because you can just go to your policy, take that policy loan, and you have that completely unstructured repayment source. You get to determine, as a cash flow from whatever opportunity you've invested in or investing back in your business, that cash flow is ultimately what comes back to repay that loan. And the flexibility there is why that's such an important tool for us. So that was the early revelation that I discovered. But as you sort of dig more into this, you realize that same tool that we're using to give you that flexibility and that access to the control in your cash flow, you're also creating that retirement cash flow stream down the road. But again, using those corporate dollars, because we're starting these policies inside a corporation. We've got those 88-cent dollars we always talk about. But when we get down the road and people want to use these later on in life, we've now got that same policy and same structure that we can start to create that non-taxable cash flow back in your personal life, so that you can enjoy your retirement, travel, whatever that might be. And then the end game for that, obviously, is you've now got that estate plan too, because that money is going to flow out from the death benefit ultimately to your beneficiaries and your family, completely tax-free at the end of the day. So the fact that we have that same tool that covers all three of those aspects, we've got saving investment plan, we've got retirement plan, but we also got an estate plan at the end of the day. Again, coming from the traditional banks, that was just such an eye-opening thing.
Yeah, I love it because, people often, when they first learn of this concept, they purchase a policy or two or three, personally or corporately, for, maybe one thing they're most interested in. Yep. And then as the policy grows and as they get older and as they hopefully become more successful, that evolves. And, we've got a lot of clients that estate planning wasn't on their radar when we first met them. But, fast forward 5, 10, 15 years, and all of a sudden they've been able to use their policy to take advantage of opportunities, grow their business, and they've been successful on their own, not just with the policy. And now they're at a point where, wow, well, that tax-free retirement is a little more exciting than back when I started this and I was just trying to save money in a tax-efficient way. That estate plan, I see the benefits now of, what am I going to do with this wealth I've accumulated through the years? So yeah, it's just about it is every stage of your life. Like from the time you're 14 days old till the day you die, there's an incredible strategy to be used at every stage along the way in these cash value life insurance. So I love that.
And we're starting to see that now as we do annual reviews with our clients and stuff. They're starting now to ask about, you mentioned back in the beginning that maybe we can use this as a retirement plan too. Can you tell me a little bit more about that? So we're planting those seeds early on, and it may not be relevant in the beginning, but ultimately, again, we're using that same tool and they can start to use that down the road.
Yeah, I love it. Okay, we're going to go to Jake. Jake, what about you? What surprised you when you first started learning about this? When you first started learning it from birth, when I started, whispering in your ear as a baby, cash value life insurance. But when you entered this career, what surprised you?
What really surprised me is just seeing how many people have these policies structured poorly when they come to us, and how how much incorrect knowledge is out there. People will come from working with another advisor. They say, "Hey, great, I want another policy. I already have one or two of these set up," and we take a look at the policy, and it's not structured well for cash, or it's with a company that's not going to give them early access to cash if that's something that they're after. So, just seeing how much incorrect information is out here, and the consequences of working with the wrong team and working with people that aren't experts like we are on the subject, and how much of a problem that can lead to down the road, and even in the early years when they need access to cash, they think they have one thing and they really don't. And it's hard to break that news to people that they have this poorly structured policy. That's probably the biggest surprise.
Yeah, I've had many of those conversations we all have where it's like, turns out this policy you've had in place for 5, 6, 7 years, you have next to no cash value in here. It wasn't set up with the right company. You can't access hardly any loan at all. You can't access 90%. You can't change the policy now. And again, to Jake's point, it's unfortunate because, if you don't set it up correctly with an advisor that knows how to structure it properly with the right company and the right structure, it's really too late down the road to do that. So that's why we always encourage people, before you buy that first policy, corporate policy, personal policy, especially if it's a significant size, before you buy it, reach out to our team, and we're happy to take a look at it before you implement it. Because oftentimes people come to us and go, "Oh, well, can you fix this policy?" And if it's not with the right company, oftentimes, or majority of the times, the answer is no, we can't. We can make sure the next policy is done properly, but they'd be so much further off if they had dealt with someone like us that knew what they were doing initially. So great point, Jake. I like that. All right, Connor, what about you? What surprised or shocked you when you started learning about this concept?
Yeah, I think both what Dan and Jake mentioned have been awesome. I've got kind of two main ones that come to mind. The first one kind of relays onto what Jake was mentioning there is the policy is not actually the investment. And I think in the traditional financial planning world, this is like a common thing that we get inundated with is the rate of return, right? And sometimes people use different structures like a universal life policy that's, investing in the stock market because you can get a high rate of return. And that's not necessarily what we're looking for here. And with the concept in general, it's more of it's the tool, right? It's the foundation. And so we're not looking for, trying to tell someone that they're going to get a 15% or 10% average return every year in here. It's a nice solid growth rate, dividends 6.25 around there. That's competitive, but it's more so what this can do for us. And the thing for me as well too is like, people do get hung up on that is like, what is that number? What's that return? But you need to dig in and do a little bit more research, I think, to then get to overcome that. And I think it's a struggle for a lot of people. But I like when we're on a call and someone comes in and they're like, my regular advisor says I can get some higher return. Well, that's great. Do that. And first put it in the policy. If you can go get 10 or 15% and you think you can, do that and you're confident in it, no problem. Do both. And so I like when we look at like the charts on a call where like you got the stock market returns, which have those yo-yos up and down, and the times when you might need it the most, when there's that drop, when that average return isn't actually the average, it's the actual. Like I know you talk about all the time, Darren. And the traditional portfolio they might have is down. They don't want to sell, or they don't want to liquidate like down in a downturn. You can use the policy at that point and then still go take advantage of that other return that could potentially be pretty large back on the upswing. So that's a big one that I know I had for myself. And kind of with that, the second thing that was coming to mind for me is the power of the zero line and interrupting compounding. So something we talk about on every meeting with clients is the compounding interest curve and how we're trying to eliminate the wealth destroyers that knock us off of that curve. And so one thing that I learned, and I didn't learn it until we first connected, Darren, and we got on our first education session, but the tool that you are using for that saving, when you knock yourself off of it with some of those traditional plans people follow, TFSAs, RSPs, mutual funds, whatever it is, we were saving for our first property, which was great. We were good savers, put money aside for like 5 years, we're at a good spot. And then all of a sudden we use the money to put it into a rental property and it's back down at zero, where if I would have known about the strategy, would have, could have, should have, of course. But if I could have used a different tool, which I now have implemented, it continues to grow. You can access the funds, pursue that rental property, pursue that business opportunity, whatever it is, and continuing on that curve instead of dropping back down to zero. So I guess the revelation or the takeaway for me with all that is unfortunately we don't really get taught any of this stuff in school. So like that education session that we had, Darren, it literally, like, not to pump control and compounds tires or anything, but it did change my whole perspective on, you know, finance and savings. Is like, holy crap, I've never thought of that lifelong curve and like how important it is to stay on it. So luckily, you know, now I can do different things to continue to ride that curve, but just being careful about the tools that you're using, why you're using it, right? Not just looking again back at the rate of return and like looking for a number, but how is this serving me, and what's it going to do for me long term?
Yeah, I love that, Connor. And for those that weren't aware, Connor first was a client of Control and Compound, and then we had what he thought was an annual review one year, and it was actually an interview. And anyway, it all worked out, and he's a valuable member of the team, and we're happy to have him. But I think he made some really good points, because early in my career, that I would struggle with that, where I can get a higher rate of return there. And now, to your point, anytime anyone says I can get a higher rate of return, I'm like, great. Why don't we get 2 rates of return? Why don't we put it in the cash value life insurance first, and we take advantage of that? It's an and asset. So there's no investment that you can come with to say I can get a higher rate of return where it wouldn't be better to do both. So that was a great point. So I love that. So yeah.
And one other thing on that, sorry, is we talk, and I was just emphasizing the company name, Control and Compound. We just talked about the compound, but the control word, how important that is as well. Going back to like when we're looking at the charts on a call with a client of like the dividends and how they've been so consistent, never missed one in the last 150 years. The stock market, you know, has some really good years, has some down years. Like the year I always like to highlight is 2008. Is like, you know, it's great if you're in on the stock market. We're not against that. But when that negative 40% or whatever it was is there, that's where that control word becomes so important. And if you've got that solid foundation, that, you know, you're not riding those downwards with your whole portfolio. If like your fixed income or a portion of it is in the cash value, you can then also go take advantage. So the control and compound, you know, you learn about that on an education session with our team, how important those words are. But those were big takeaways for me, and like, you know, surprising when I first learned about all this.
Pretty good name, isn't it?
Yeah,
Pretty good name.
pretty smart.
Yeah.
All right, Christina, what about you?
Yeah, I just want to talk a bit about just following up on the compound. It's funny because you hear about like compound growth being, you know, so important, but it's that uninterrupted compound growth that is the important piece. And I was just thinking through one of the most shocking things that we go through with clients, and it still shocks me to this day, is when we run an example of what happens to your dollar after it gets hit with our 4 wealth destroyers, right? So you've got a return, and then you throw taxes in there, then you throw fees in there, then you throw your volatility in there. And you watch that number plummet, like actually plummet. And it's still like, it does still shock me when you look at it and you're like, we just went from 500 million down to less than $1 million overnight in adding our wealth destroyers. So I think that one's important with the uninterrupted compounding. But another one that I wanted to talk about that continuously surprises me to this day is the misinformation that's out there. I think, especially over the last few years, infinite banking has, you know, been more and more talked about. You hear about it from different individuals, and they're, like Jake had explained, not everybody is as educated in it or that they specialize in it, and they're giving a lot of misinformation, like information that is not correct. They're not just not structuring these properly, but they're also providing information that's not correct, and, you know, getting people to take on other investments that might not be the right fit for them. And that really bothers me, right? Because it's, you know, it's not ideal for people to be getting, and it's so available these days on social media, right? People talking about infinite banking and the strategy. And it's not great. And it's something that I think we need to get away from. So when you're talking to someone that does investments, they do your group insurance, they do your RSPs, like, it is highly unlikely that they specialize in this strategy. So they may not be giving you the right information. If you're talking to someone that just got their insurance license yesterday, and it is very easy to get an insurance license these days, they're probably not going to be able to do this for you correctly. If they're not okay with meeting with your accountant and your lawyer and working with them as part of their team, or your investment advisor, because you're doing a strategy that includes your investments, they're probably not the right fit for you. So it's really important that, and it goes back to working with the right team members, like Control and Compound and our guys here, putting in that education. Like, you guys are investing in yourselves on a regular basis and making sure that you understand this through and through, and not just infinite banking as one of the strategies. We know corporate strategy inside and out. We can help with corporate. We can talk talk about lending strategies. You've helped numerous clients with different lending strategies that we can do with these policies. And it's not just one piece. There's a whole bigger picture here that I think people are missing, and they're taking little sound bites and they're deciding it's not the right fit for them. I think people should take the time to learn about it, educate themselves, listen to these types of podcasts, and then decide if it's the right fit for them. So it's still really surprising to me that there's that crap floating around. But, if you have any questions, or if you come talk to us, we got a full team here that knows what they're talking about, and they're happy to help and answer all those questions and debunk some of those myths that we hear about.
Yeah, I find that frustrating too, Christina, because let's face it. I mean, in the insurance business, there's the vast majority of people, they're predisposed to say no, right? Because they've heard horror stories, or they don't think they need insurance, and there's all this thing. So people don't understand the concept. So when you get an advisor that goes on a podcast or speaks somewhere, it's easy to crap on something because people are like easily willing to accept, oh yeah, well it must be crap, and then I think it's such a disservice because then that person won't spend the time actually digging into the real education of it. Like we had an advisor, or we had someone on a podcast recently, in another podcast, talk about business owners shouldn't do corporate policies or up to a certain amount unless they're making over, and it was like, I don't even know how to respond to that. It's like you like, to me, I hear that and I'm like, well, that advisor doesn't know anything about how corporate structures work and how this cash value life insurance works for business owners.
Taxes. They don't know anything about taxes.
Because it's like almost like, well, how do you even respond to something like that? Because to sort of piggyback on what a couple of you said, what I find fun in the industry is I've been in this industry a long time, and years ago, there was a lot of accountants that didn't really fully understand this concept, and they wouldn't recommend it to their clients, or it was just easier for them to say no, just no, you shouldn't do that, because they weren't willing to spend the time. And the shift through my career has been incredible, where I think I shared the story once. I met with the largest accounting firm in Canada, their tax strategy guy, and it happened to be the day after or 2 days after the last budget. And I go in the boardroom and he's there with a couple junior accountants, and he's like, well, you must be happy. And I'm like, what? He goes, you're all we got left. He goes, just about every single business tax advantage every tax advantage business owners has had has been eliminated in the last 10 years. And he goes, you guys have an incredible strategy, and it's really the big one we have left for Canadian business owners. So, as much as I'd like Canadian business owners to have other strategies too, and there are, some minor strategies, this is the number one strategy for Canadian business owners. And the fact that the major accounting firms are actually big promoters of this now has been a real shift. Now, we still find the odd accountant that doesn't love it because they don't know about it, but to Christina, you're incredible on the corporate side, where you become part of that team, working with that advisor or working with that client to say, I'll meet with your accountant and your lawyer, because you have so much knowledge that you can do that, and so can the other members on our team. I think it's just been so nice to have professionals in the accounting world embrace what we do, and it's refreshing. Anything else from anyone? Kind of surprises, things that you're still shocked when you see today?
I'll add to your point, Dad. The same person you had mentioned, actually, we saw him speak at an event a little while ago, and he had explained that with an accountant, if they don't understand a concept like this, where it may be a little more niche, it's really easy for them to say no. Because there's no risk on their end saying no to a decision. But like you said, it's great that we have a team that we can work hand in hand with someone's existing team. Just make sure all the pieces fit together, and that we can incorporate ourselves into that.
Yeah, I mean, we love working with accountants and lawyers. Like, there's some people in our industry that it's like, oh, you don't need to show this to your accountant, and it's like, why are you not confident that you can explain it to the accountant? So, we spend a lot of our time meeting with accountants, and we embrace accountants. We love accountants, and we love infinite banking. We love cash value life insurance, and we think we do a great job here. And we love working with business owner clients and individual clients.
And I just have one last thing to add to that too. And I think I can say this as a former client before I was a team member. It's not as biased, but one of the common things I think we were talking about is like it is harder to unlearn something than it is to learn something new. Like once you hear life insurance is a bad place to put money, or don't do that. I've got this better option. Like you hear different people, like we're saying, kind of spreading different information. I would just invite people that, for some of that proper learning on this concept before you make your decision, like get all your education, but speaking with our team, like that's where I started going back to the beginning is hopping on a call with Darren. I remember talking with you, Christina, as well. Then going through some of the education that we talk about, make your informed decision, see, if you have questions, we're happy to answer them, but just a little plug for scheduling an education session that we do for free. Cause we're all about teaching this because we really believe, and I know what happened for me, once you understand and you can kind of debunk some of those myths perhaps, or get your questions answered, that when people understands this, it starts to like click pretty well. It makes a lot of sense, but you just sometimes have to do a bit of that effort and maybe unlearn a couple things you've heard previously. But I think I can be a testament to when you're willing to put in that work that it's worked out really well, and I'm very happy I did so.
Yeah, I always remember a mentor said to me once people learn this concept, you can't unlearn it. Once you catch it, you can't uncatch it. Like once you have that knowledge, and to Connor's point, you go through that education, and you're like, that light bulb goes off, and you're like, and then all of a sudden it's a multitude of ideas. Oh, so I can use it to grow my business, and I can use my investment properties, and I can use it for this, and I can use, and they start coming to you with, I can use it for all these things, because once that light bulb moment comes, you can't uncatch it. So. All right, everyone. That's another Control and Compound episode with our wealth coaches. Thanks for watching. Thanks for listening. Have an awesome day. Thanks for watching that episode. Don't forget to subscribe to our YouTube channel. Click that like button. Hit that bell button so you never miss an episode. And if you want to learn more about us, go to controlandcompound.com. We'll see you next time.
Thank you for tuning into this episode. The information contained in this podcast is for informational and entertainment purposes only and is separate and apart from the wealth coach services provided by Darren Mitchell and Associates, Inc. to its qualified clients. Control and Compound Financial expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, or any other damages arising out of any individual's use of this podcast or the information in it. The views expressed here are those of each participant and guest and not necessarily those of or endorsed by Control and Compound Financial, its affiliates, subsidiaries, and their respective directors, shareholders, officers, or employees. For full disclosure, visit controlandcompound.com/podcast-media.